Let's see. Let's see. Let's see. Right, so I am starting this a little bit early, but it's just going to pretty much be the meeting room. So nothing's going to quite get started yet. I'll let a few people come in, and then we'll get started with the meetup. And so let me see. Hey, how are you guys? I just sent out the email. Sorry if I was spamming you guys. Got a lot of questions about whether they could see or hear or if it was online. So wanted to make sure everyone had the right information. How are you? Hi, Kari. How are you? So let me just start here. I'm debating whether I don't know if you guys would rather make it more conversational or more like a presentation. My background is trading and investing. I've been doing it for over 10 years. I'd love to know what you guys would like to see or hear or talk about, or if you want to talk about your own trading experience. Um, so feel free to unmute and start your own video if you guys would like, or feel free to not not do so if you would prefer not to. All right, so I'll let a few more. I'll start right at 11. I think admit. And then so far we have hi James, hi Lisa, hi Kari. I do want to feel free by also if I mispronounce your name, feel free to let me know right away. Yeah, I will start off with some of the questions you guys asked me. I found them to be really, really good questions. And I would love to know what you guys are hoping to get most out of the group. I know for me, I've been trading for over 10 years. Um, it's my primary form of income. Without obviously nothing I say is a buy, sell, or hold recommendation. You can lose all or more of your capital to investing in the financial markets. My goal for this meeting is to make sure not only you guys don't lose all or more of your capital, obviously, but also trade in a way that is conducive to your psychology or to your personality at this time. Hi, Lisa here. So I'll have the chat open so I can see everyone. Um, so feel free to at any point speak or mute yourself or cut me off or write in the comment section for everyone. But a little bit about me is that I am really passionate about the markets. I've been trading them for, like I said, over 13 years now. Um, and I started off in LA when after the market crashed. So the reason I started trading and investing in the financial markets was because I lived through the real estate crash with my parents. I'm first generation American, and so for my parents, the American dream was always what we know it to be, right? So they did it through real estate. And so I turned 18 as '08 happened, and I was just moving to California. And my parents, although thank God they didn't lose anything, were in a situation where they were about to, because real estate is not liquid. So being first generation American, I always wanted to be in the or experience or come here for the American dream. And so um, in doing that, I knew that I didn't want to do it in real estate because of what I had experienced. Although now I do love real estate, and so during that time, hi Dorian, I've said before, feel free to cut me off at any time or unmute your mic or turn on your video. Until then, I will just keep on talking. So what happened was I knew I was really big in the American dream. I was scared of real estate because what I had experienced in the real estate crash, and so I ended up doing a few commercials when I was in LA, and I put that money into Tesla, not knowing much about the markets at all, or not a lot at least. And so, as you guys know, how that story turned out. So something that in the transgression and something that happened amidst all of that is I became a student at OTA. I don't know if you guys know All in Trading Academy. And so I learned futures forex, and I was primarily interested in options. OTA was not the best learning experience, depending on how familiar you are with that. But I did become an employee, and I got very close to that leadership. I ended up reinventing a lot of what options, equities, and futures were traded as, and from the standpoint of um, reverse engineering it. And so, because of what I had experienced in '08 with real estate, I was if you guys are newer or not so in markets, let me know. But it's usually psychology that tends to be the biggest. Uh, the biggest issue with most traders, right, and why they lose money. And so something that I had a somewhat of a fear of loss after what happened in '08, even though I was invested in markets. So I came to a point where I had nothing to lose. And it was kind of one of those points where you lose everything and find yourself. So that's when I had put money into the markets and Tesla and what have you. After I started acquiring a decent amount of savings, and I became a little bit more scared of the markets. Um, and so I do notice that a lot of people are tend to be in two camps, right? They are either paralyzed and engaging into a trade because of the fear of loss, or they're overly exuberant and tend to lose more than they would like. So during the time that I was an OTA employee, I became one of the top traders and presenters. And something that I really started to develop more so for myself was a trading strategy that revolved around my uh, fears, or rather overcoming them, or in a way that I wouldn't be overly exposed more than I would like, right? So what that ended up evolving to was getting further and further away of directional trading in equities and futures and forex, and more into options. And in the middle of this process and my and trading options, I realized trading supply and demand, which also goes back to first principles, and I'll go over first principles here in a bit, which is kind of what my slide and even my trading ended up being designed on. So I will, I guess at this point, I will go over what first principles is. Hi, Kari, also a student from them. Yeah, so Samsat and I are like really good friends, and that's another story for another time. But so what I ended up doing was essentially, and knowing all the asset classes and futures, equities, and options, I ended up not only designing a strategy that was conducive to my objectives, but also that overcame a lot of the issues that I had. So I ended up getting mostly into options, primarily because of the current market conditions and because this really weird fear of loss and market crash and fear mongering that was going on. So at that time, if my biggest fear at the time was an overnight gap or the market crashing overnight or something like that, then the best way to is going to circumvent that fear was buying out of the money calls, right? If I was bullish, or put if I was bearish, because I wouldn't have that exuberant gap in leverage that you would see in the futures market. Not to mention how tight your entry stops and targets have to be if you're in the futures, forex, or equities market. But also, um, whatever I bought up front with buying an out of the money call or a put is the most I could lose, right? So for me, during my more anxious periods in life, was a big driving factor. So um, when we think about supply and demand, right, and first principles, I think when we hear things like buy low, sell high, it's almost insulting, right? So every time I heard all of these trading and investment cliches, um, I don't want to say they annoyed me, but it wasn't anything substantial to look at or to learn from, right? And so, but with that said, supply and demand by low so high is something that is rooted in first principles. And so I will go back into, I don't know if you guys follow Tony Robbins or any of the personal development gurus per se, but they often say come in with the end goal in mind, or reverse engineer your goals or what have you. And so what I ended up doing was exactly that, right? What are my fears? What am I trying to accomplish? And how do I, first and foremost, create a trading world and environment that revolves around what is psychologically comfortable for me, first and foremost, because I can give someone, when I was an instructor there, or a presenter, I could give someone the best strategy, but if they were unable to apply it, um, for fear of loss or otherwise, then it really wouldn't matter, right? So uh, supply and demand, or what we know as price action in the markets, is fundamentally rooted in first principles, right? Which is something. So now we'll read what first principles actually means, which is something that Elon Musk is a big fan of. When he started SpaceX, he wanted to get into the world of rockets, right? And so he knew that rockets were very, very expensive to make. And so he asked himself, well, why are they so expensive? Is it because the components are expensive, or because the manufacturers sell it for a very high cost? So what he basically realized is that creating a battery, or the components, excuse me, that make up a rocket, are not very expensive, but the distribution line and distribution chain is what is expensive. So by law of first principles, he's like, okay, well, what do I need? I need materials to create a rocket. Are those materials very expensive? No, but rockets themselves are. So what I need to do is then get a team of people that know how to use these resources in a way that it can create a rocket, and therefore circumvent a lot of the expenditures. So first principles thinking, which I don't know if you guys can see my screen, is basically thinking, which sometimes called reasoning from first principles, is one of the most effective strategies you can employ for breaking down complicated problems and generating original solutions. It might be the single best approach to learn how to think for yourself. The first principles approach has been used by many great thinkers, including Jonas Gutenberg, military strategist John Boyd, and ancient philosopher Aristotle. But no one embodies the principle of first principles thinking more effectively than entrepreneur Elon Musk. Open quotation. I tend to approach things from a physics framework, Musk said in an interview. Physics teaches you to reason from first principles rather than thinking by analogy. So I said, okay, let's look at first principles. What is a rocket made of? Aerospace grade aluminum alloys, plus some titanium, copper, and carbon fiber. Then I asked, what is the value of those materials on the commodity market? It turned out to be the material cost of a rocket was actually 2% of the typical price. So why am I talking about first principles in trading? Well, if we think about the benefits of the financial market, right? The benefits of the financial market when it comes to financial freedom is, and why I like it better than real estate is because, like real estate, you do have leverage, right? But you also have liquidity, meaning that if something turns against you, you can cash out right away, right? If the market go like, right now, it's a great example, right? A lot of landlords cannot charge rent, right, because of current market conditions. So when that becomes illiquid, you're stuck with the time decay of that asset, right? When the market crashed in '08, my parents couldn't my parents couldn't sell the houses per se, not at the value. They were underwater if they tried, and they weren't necessarily being rented out either, right? So they were not liquid, is my point. And so that ended up costing so much of the money. Heidi, how are you? Um, and so because the markets, so like real estate, which is often a commonly depicted tool of financial freedom, um, the the difference between real estate and sorry V, I didn't mean to mute you, and you can actually make a comment at any point. I could just hear you, so if you want to speak, by all means, just let me know. But um, like uh, like real estate, you do have the leverage, right? But in equities, you are a lot more liquid. Now, by understanding that, they are more liquid, we must understand also the psychological implications of being more liquid. That means that it has a lot more psychological room to over leverage, to buy way more than maybe we should be able to, without necessarily understanding the markets. Where in real estate, to go into that much leverage, you have to have some cognition of real estate, right? Only because the underwriting process and all of that is so intense. And so in that sense, the benefit of stocks is liquidity. It is a very low barrier to entry. And so what I mean by that is futures has about a 20 to 1 leverage, options about a 10 to 1, and Forex about 50 to 1 in America. And then internationally is that much more. Again, the downside to that is that with a lot of money comes a lot of responsibility, right? Especially with control. And again, if we, by law of first principles, if we think about why people end up not being very successful in the markets, you can usually deduct it back to a lack of proper understanding or psychological components in conjunction and in tandem with lack of psychological understanding. And so, but with that said, there's a lot of ways to circumvent around that, right? So if someone does want acquire financial freedom or want to through the markets and they don't have any money, well, if we take the basic framework of what we're trying to accomplish, then we can set our rules based around that, right? So what does that mean? Well, that might mean trading, for example, if you have no money in savings, it might mean trading futures on simulation and testing a strategy over and over and over again, make sure that it works, following the parameters of, for example, a prop firm. And so, what a prop firm essentially is, it basically means that you can pay about $150 a month while you're testing, while you're in pilot for the parameters um, of that framework or that prop firm. And so at that point, once you get approved, which can happen in about a month, especially having already tested your strategy in congruence with the prop firm's rules, you can essentially get approved and then trade other people's money. And the way that works is after you get approved, you split your profits 80-20, right? So if you make $10,000 a month using their money, because again, in this scenario, you had no savings, then upon approval, then you give them 20% of your earnings, you keep 80% of it. And so by the material law first principles per se, if you're in a camp of you don't have more than $200 to your name, then the best thing to do would be by deductive reasoning and knowing that prop firms exist would be to understand the parameters and rules of a prop firm and then apply those rules to simulation trading and maybe focus only on the NASDAQ, for example. And so then we can break down futures in this circumstance and do what is your personality like, right? So are you a 30-minute active market mover in the morning? If so, maybe the NASDAQ futures might be for you. Are you more slow and steady? Then maybe NASDAQ after hours or the 10-year treasury might be for you. And so then you are engineering a world and a process with the end in mind, in the sense that you are, I have no money. I want to make money. I want to make $4,000 a month of monthly income. And to do that, I'm probably not going to do it with options, or you can do it with Forex because there's also platforms in Forex. So by that, then, okay, if that's my goal, then I know I need to learn the futures market and I need to learn it on simulation because I have no money of my own. And if I'm going to learn it on simulation with the goal of entering into a prop firm, then I will make my rules the rules of the prop firm. And the reason I'm going to do it on simulation is that so I don't have to pay that $150 a month while I'm training and learning those rules and parameters. And so, in that sense, uh, now we have a roadmap. So, and when we have a roadmap, it's easier to focus on what we need to focus to acquire that goal than to be overwhelmed with what are futures, what is Forex, what are the benefits of options, how much, what should I do, should I get started, should I trade NASDAQ, or you eradicate all of the fluff that comes with mastering a new subject matter, and you are then now only focused on what you need to acquire those goals, right? And so my goal for this group is that no matter where you are in the spectrum and trading, that you can formulate a roadmap that can lead you to financial freedom that is not finicky or or anything like that. Excuse me, give me one quick second. If not, that's fine, whatever. And now we know exactly what you need to focus on to acquire those goals, right? And if you are like me, where you are more advanced, you do have more capital, then you have more flexibility, and we can focus solely on your personality and a strategy that is congruent to that. And so that would be, for example, a roadmap, like I stated, for someone that maybe has no money and is just getting started in the markets. And so my favorite asset class is options. That is what this group is titled, but I do trade all the asset classes. And so options is 10-1 leverage, futures is 20-1, Forex is 50-1. Unlike real estate, you can get in and out of your position with ease. And so then the question is, how do we know when to buy or sell, which does go back to first principles and supply and demand. So this is only a 2 hour or so meeting, is our first meeting. At any point, feel free to interject or stop me if you guys would like. But so I'm going to go ahead now and go to the next slide here, which is by law first principles. How does that apply to a market, right? And really, how we do one thing is how we do anything. And so what that means is really what I've focused on that may be exponentially profitable. And as you guys saw, since COVID, I got about a 264% return. Is really understanding that how we leverage one thing is how we leverage anything. And so let me see. And so when we think about what makes someone a successful trader and what makes someone unsuccessful, we can tend to deduce it to basic commonalities, right? And what I often hear the most is people blowing their account, right? So if you have experienced that as a trader, then the question is, well, if that's your biggest fear, if having had blown your account once because maybe you didn't know trading is what is holding you back, then how do you circumvent that, right? Well, the way to eradicate, so something that I would want to focus on first if I was getting started in trading is, what are my biggest fears that are going to keep me from being successful, right? So if your biggest fear that's keeping you from being successful is the fear of loss, right? Because you blew your account. Well, the way to circumvent that is to not invest any of your own money and really only focus on going with a prop firm, right? Because um, people seem to be dominated by the two polarities, right? Fear or exuberance. And so when that happens, we can focus on on killing off anything that's going to keep us from being successful. So tackling any fears you might have appertaining to the markets in any way, shape, or form. So if you are on the boat, for example, of having had blown an account, then and that's keeping you from the markets, then let's focus on prop firm, right? Which means let's focus on forex or futures and the parameters of a prop firm, and then starting and opening up a simulation account that follows the guidelines of the prop firm to create a vehicle where not only can you accomplish your goals, but then you're not going to take any mental real estate being consumed by potential fears if you're going to sleep at night wondering if on Monday the market's going to crash. Well, if it does, the most you lost is those $120 that it took you to get approved to get a prop firm account. Even if you have $1 million in the bank, we are addressing what's keeping you from success rather than the most accessible path to leverage or to put you in a position where you're predisposed to maybe fail, right? Or to create a self-fulfilling prophecy. So when it comes to buying in the markets, we know that we buy low and sell high, or we sell high and buy low, and to reinstate that, it's insulting. So what does that mean in everyday life, right? Because we always hear that phrase of nauseam: buy low, sell high, buy low, right? If you're a short seller. So now by taking that at its basic fundamental level of supply and demand, and so without going with supply and demand trading strategy within of itself, let's go by deductive reasoning of what is supply and demand. Well, supply and demand is the willingness to buy something, and then the price of something will rise until there's no more willing buyers, and will fall until there's no more willing sellers. So by law of first principles, if you never saw anything in the stock market before, you would go into Walmart, let's say, and you see a television that you love, and you're on the fence of buying it for $1,000. Now, if you are willing to buy it at $1,000 and you're at the fence for buying it at $1,000, and then next week you go into Walmart and it's $500, well, you're going to buy it at $500 because you were willing to buy it at $1,000, right? So what do we know so far? We know that there was something that we were willing to buy at $1,000, a television. We know that we bought it at $500. The you know, because we were willing to buy it at 1,000, so we ended up buying it at 500 because we were willing to do so. Um, and so now we know that we're walking away from the store happy, having it had bought it at $500 because we were willing to comfortably pay 1,000 for it because we were on the fence at 1,000, right? So then if we go back to Walmart next month and then now it's selling for $400, which is a 20% decrease from 500 where we bought it at, we're not going to blow our minds or, you know, jump off a bridge per se, for lack of a better term, because it's something where we were happy owning it at 1,000. We walked away at 500. So at 450, we're still at peace because we got it at something we're more than happy to pay for it, right? So then the question is, well, how much of it are you willing to buy at 500, right? If you buy 1,000 units of it, and then you can sell them at eBay or what have you, right? My point for this exercise is that if you go into the markets with that level of thinking, you're never going to wake up coulda, woulda, shoulda. You're never going to have a panic attack in the morning. You're never going to be stressed and pressed about what's happening in the news and the political atmosphere or the markets because you didn't commit to anything that you were not willing to commit to, right? So then, by that basic framework of supply and demand on a universal standpoint, we can then see how does that apply to the stock market, right? How does that apply to futures? How does that apply to Forex? Because if you look at a lot of these companies, right? So I paid like $27,000 for my education. A lot of people pay 50,000 or, you know, even more, unfortunately. But if we unplug from, you know, all of that stimuli, what we are left with is looking at something that oftentimes people will oversaturate you to make you feel like you had value, right? And they'll send you 60 indicators, right? They'll send you 60 supply and demand zones to buy oil, gold, copper. They'll send you, you know, 17 Forex alerts an hour, right? But if we think about it from the law of first principles, no one is going to go out and take, you know, 60 trades, right? You know, the margin alone for just having those pending orders would be unsubstantiated for most people in that market or those market conditions. So then how do we position ourselves in a way where the path of least resistance uh, is also the path to success? Well, again, let's go back to a very basic law of first principles and deductive reasoning. If you look at supply and demand, and now let's take it to houses, right? Because that's more applicable than televisions in the following context. If we look at real estate buying and selling, which is something everyone can understand, and you have a neighborhood, right? Let's say, and you see the price of a house, right? And are you do you want to buy that house in the context of the best price that it's been in the last 4 hours? Meaning, do you want to buy the house and the best price that it's had in the last 4 hours, the best price that's been in the last week, the best price has been in the last month, or the best price has been in the last 10 years? Well, likely we want to get in to something in the best price that it's been in the last 10 years, right? Does that mean that the municipality or the city filed bankruptcy? Does that mean that, you know, they defaulted? You know, we can think about that later, right? Or that can be the second thing to analyze. But from a very simple deductive reasoning standpoint, we know that more often than not, we want to buy something from the standpoint of the best price that it's been in the last 10 years, right? In the last 10 years, it was probably, you know, 50% the price, right? So, with that ideological framework in mind, then we can focus on the path of least resistance to becoming profitable, meaning that if you're purely a Forex trader and I only trade USD pairs, right? So USD CAD, USD Aussie, USD dollar, um, Duh, USD dollar, USD euro, or euro USD, excuse me, because they're major pairs, right? So I only trade the major pairs. But if you set your alarms, let's say on a Sunday, uh, and the same applies to the Nasdaq and Apple and Google and what have you. Do you want to buy a stock, a future, or forex in context to the best time frame demand over the course of 10 years? Well, that's probably has a higher likelihood of success without abusing leverage because in a sense you're throwing water balloons rather than darts, and you can position size more comfortably because this is a longer time frame play. And then if the 4 hour, the 1 hour, the 15 minute, and the 10 year tend to line up, well, then we can consider those additional factors for a more immediate trade. But if we're focused on the best price something has been over the last 10 years, then we have a much higher likelihood of having it be a successful trade so long as it doesn't file bankruptcy, right? So, how do we address then looking at something that is the best time frame or the best price in the context of the last 10 years? Well, luckily in the financial markets, you can pretty much, and let me switch my screen very quickly. Um, in the financial market. So I'm gonna do a new share, and I'm gonna share my Thinkorswim platform, which I did on demand. So I rewinded in time. Can you guys see my Thinkorswim screen? So luckily, to avoid this situation or circumstance, something that we can easily do is basically go to the watch list. And so the watch list can always be catered to your personality, as had stated earlier in the video, right? That we want to find what is congruent to our trading style personality by first principles, or your schedule, right? If you do have a full-time employee. But now addressing how do we find the best opportunity in context to everything we're looking at, because we have hundreds of markets, forex pairs, what have you, stocks. And so luckily we can always adjust our watch list by percentage points, right? So why am I doing percentage points? Well, because if you only want to risk $100, let's say, or you only want to invest $100, you can buy one share that's $100, or 100 share that's $1, right? Your buying power is the same. So then what matters is the percentage move of that principal. And so for that reason, we're going to look at the highest to lowest time frame. Now, I am bull side biased, and I'll go over why I'm bull side biased in the next following slides. But what allows us to do if we're just starting off is that it's showing us the burst percentage opportunity based on the market movements. And then we can look at correlations and all that is much more advanced. But the point of this example is basically being able to index the ability to high probability trades um, based on the parameters we had just set forth. So now I'm going to go back and share the screen that I was just sharing, which is the keynote. I'm sorry, did someone have a question? I thought someone did. Okay, anyway. Thank you guys for being here. Welcome, Guy. And if you do have a question, let me know. Or if you want to speak, by all means, feel free to stop me at any point. So by that reason and logic, we are now positioning ourselves to get in a trade that may be the most opportunist for this morning, right? Or for the day in which you're indexing that percentage move. Now, realistically speaking, as you become more of a first principles mindset being, because it's not just exclusive to trading, but rather everything, then you can set your willingness to buy zones on a Sunday and basically set them up by alarms, meaning that for example, I know that if an apocalypse happened, no matter what happens in the market, I'm going to be willing to buy Neo, let's say at $8. This is one of the trades that got me a 5,000+% return. So what I can do is I can set an alarm on the weekend, like today, and basically whenever price crosses that line, I will know. And so in that sense, I will be positioning myself to free up as much mental real estate as possible by having mechanics and tools in place that I understand and know are the most conducive to my trading style and personality, and why I want to be able to acquire, or I'm able to acquire these level of returns based on that level of positioning, and quite frankly, being able to free that much mental real estate in that sense. And so, um, with that, at this point, we can deduct our basic psyche, right? And so, for you guys who do or maybe don't know me, I do have a YouTube channel, and in there, I have a video that talks about creating a trading plan, right? And why did I do that? Well, because by law of first principles, we want to know what we can and cannot do based on the psychological limitations we already talked about, right? If you only have $100 to your name, then it might be best to master futures on simulation and then go with a prop firm for financial freedom if that's the goal, or to make monthly income. Now, if inverse to that, you are maybe a full-time employee, right, or you have a night shift, well, based on that, we're going to reverse engineer your challenges and or your advantages, right? So if you're in a position where you can only trade from 4:30 in the morning Pacific Standard Time, Los Angeles, to 6 in the morning, then we know that based on those parameters, we're going to focus specifically on Forex, right? Because those are the most conducive in the London to US session overlap. So before we get overwhelmed with stocks and options and futures and the benefits of this and that, you are solely focused on what is realistically possible for you in this now moment, which is Forex based on your schedule. So then we can focus on applying those first principles on Forex based on what we know to be true in your life that's not going to change in any immediacy. And so in that sense, we can then focus, okay, so if you do only have this time available, well, what kind of a trader are you? Are you very risk adverse? If you're very risk adverse, then we're only going to focus on USD pairs. And if you're very, very risk adverse, then maybe we might only focus on Euro USD and USD CAD on longer timeframes and water balloons, right? So before we even open up a platform and look at all that the world has to offer, the Aussie dollar and all of these other things, we now know before ever opening up a platform what you can and cannot realistically focus on. And so, again, but just by applying things that we fundamentally, organically know to be true within ourselves, and in that sense, um, and in that sense, uh, preventing any excess mental real estate, that's really oftentimes what keeps us from being successful. And so, um, I previously mentioned that I am a buy side bias trader, right? And so I'm a big fan of obviously intuition, but also statistics and data, and trying to get as far away from opinion as possible, right? Which in first principles, there's not a lot of room for opinion. So when we look at first principles, there's certain key things that are important to understand, right? And so I will now go over 11 facts about stock market corrections. And the reason I'm going over this is to illustrate why I am a buy side bias trader. And then you can discern thereafter what better suits you. But you're not going into the market with ideological expectations or feelings or opinions. You're going in with analytics, right? And so the biggest takeaway of all of these, and I can read them one by one, but if you had invested money over the course of 10 years between 1995 and 2005, you would have endured 2 to 3 market crashes. And so, um, however, even with that being said, you would likely come out with about a 498% return. So I'm going to just read this verbatim. For nearly 10 years, the stock market has been practically unstoppable. The 122-year-old Dow Jones Industrial Average and the broad market S&P 500 have quadrupled in March of 2009 lows. Now, mind you, this was written in November 21st, 2018. So we've way past that. Investors have held through a couple of hiccups. However, over the past 7+ weeks have been challenging for a lot of investors during this time in 2018, with a lot of the market hitting correction territory, hitting a 10.2% pullback and 15% in the NASDAQ. And so I will go over now the most relevant point in this, which is here number 2, which goes over despite being so common, market corrections are hard to predict. So I'm not going to go into whether or not we can predict market corrections. There is ways to pretty favorably be able to discern them coming to fruition. But withdrawing that from the equation, I want to go over this particular set of data, which is if you held from January 1st, 1995 to December 31st, 2014, you would have netted a cumulative return of 555%. Or 9.9% a year. Mind you, that includes holding through the dot-com bubble, the Great Recession. But had they missed only the 10 best trading days over that 20-year period out of fear, their returns would have been 191%. Now, that's a lot of information, but if we rewind, what this is essentially saying is if you held through these market corrections in the dot-com bubble from 95 to 2014, holding through those would have gotten you still a return of 555%. However, if you had only missed 10 of the highest of the highest up move trading days, your return would have been cut to only 181. So the implications of this are that missing 10 of the best trading days alone could set you back 50% over a 10-year period, right? So for me, just taking that alone makes me generally bull side biased. And there's other factors that go into the equation, such as, people getting paid every first and the 15th. If you were paying at all attention to the political news, they were talking about how every year there's more and more voter turnout, right? And if every year there's more and more voter turnout, then it's likely that every year there's more and more adult participants in the market, right? If they can vote, they can probably invest in the market as well. So with those two things being material facts or true, or at least statistical facts, historically speaking, then we can basically formulate a very strong buy side bias in the financial equity market. During this time, we're going through a lot of things in the market that are outside of the paradigm of general normalcy, right? Whether it's quarantining and what have you. There's talks about this no longer holding true, and even depegging from correlations of the S&P 500. Those are deeper facts that will become relevant as you become a more proficient trader or an active trader. However, the purpose of this video and this meetup is to go over first principles thinking in general, right? And so by first principles, up until now, this is why I've been historically buy-side bias, free of opinion, attachments, emotions, or otherwise, right? And with these basic material facts, whether or not you know much about the market, you can within yourself deduct and discern at what points you may or may not be willing to buy a stock, futures, or any asset for that matter. This obviously is appertaining to equities. And because I am primarily an options trader in the equity market, I am particularly attuned to a buy-side bias because of this nature. Now, I do know that a few people follow me from Supply and Demand or from a lot of the videos on my YouTube channel. I'm sorry, did someone have a question?
Bruce.
Okay, Jose, do you have a question or? Okay, so understanding this, if you are a futures trader, then understand that although the markets are designed to go up in the equity index markets and maybe stocks themselves, which I'm not going to go into this video, the futures market, corn, soy, oil, and all those things, those do tend to follow supply and demand a lot more congruently because they tend to be cyclical and seasonal, right? And so if you are short side buys, which I know a lot of people that follow Sam Seiden sometimes tend to be, then if you are significantly attached to being a short seller or short side bias, then it might be beneficial to just focus on the futures market or the commodities market, because those tend to respect supply and demand, because they're instruments designed to hedge. The markets are really inherently designed to go up. In fact, some people are saying we're at all-time high in this, the last week or inauguration week, which could be true from a material fact, but when you consider that about 20 or so percent of the money in circulation has been printed since uh, the inception of the current environment and in 2020, then you can discern what that means to you specifically and those implications, right? But again, this is really about understanding our goals, what we're trying to accomplish in context to the tool and vehicle we might be using to accomplish those goals, and focus solely on the material facts that'll get us to those goals, and focus specifically on the tools and the route that we need to get our attention to make that to be true, or to make that come to fruition. And so with that, where am I? So this just goes over more market crash statistics. And so I will probably go over margins, statistical data. So I'm pretty sure this concludes the this portion of the meetup. Of course, I wasn't sure if I was going um, to talk about this as much, or if it was going to be more open between these groups, right? But it, the last point I want to make in context to first principles on this is that if we reverse engineer our biggest fears and our driving mechanics, right? If our biggest fear is losing money, um, well, what does that individually mean to you, right? It means we need to assess risk reward in a way that circumvents your psychological barriers, right? So if you're if you experience a lot of anxiety in your temporal body, then trading futures or forex overnight may not be the most conducive tool to your mental, emotional, financial sovereignty or success, right? So if that's the case, then we might focus starting off specifically on buying calls and puts, because the most you're going to lose is what you bought those calls and puts for in context to the supply and demand timeframes. If you struggle overwhelmingly with exuberance and maybe blowing accounts because of that exuberance, then maybe we can focus on, no matter how much money you have, on a prop firm, so that we can train by using the parameters set forth by the prop firm, using someone else's money, and never losing or blowing your own account, because the most you can lose is how much you're getting paid, or how much you're paying to be approved to the prop firm Columbine. Um, and or if you are as a rather successful active trader, then maybe selling vertical put spreads and the opening and closing intraday, if you have a more open schedule, may be the most conducive thing for you. Obviously, everyone will say they want to trade, invest in the financial market for financial freedom, right? But we must also realistically consider what our fears and limitations are when it comes to acquiring that, right? And so if realistically your fear of loss or your anxiety of loss is much more overwhelming, if you will more than $10 more than, I'll give you a quick example, right? If you ruminate more about a parking ticket than you do about your overtime, right? Then maybe trading futures and equities may not be the best thing for you during this time. And as we work through that mental and emotional sovereignty, maybe buying uh, cheaper at the money or out of the money calls between a supply and demand range is something that will be more conducive to you, right? Because, for example, because of current market conditions, I've been mostly focused during this time in, actually, I shifted the last couple of weeks to vertical puts, but I have been doing a lot of out of the money calls because I was still buy side bias, but I didn't want to hold overnight. I didn't want to use a lot of margin. and I didn't want to experience any down move or turn in the futures or forex market because of the current uncertainty. So because of that, in those market conditions, I ended up buying the $6 strike neo call for 15 cents, which obviously ended up becoming $5,000 a unit or something. $15 turned 5,000 or something like that. Because neo it went all the way up to 57, which I'm still holding. Um, and so my point to that is that's a very specific kind of strategy and focus, right? Because I was going to only focus on what is most conducive for our psychological well-being and financial circumstance to ensure not only financial material success but also focus on not over leveraging and not sacrificing any mental real estate peace of mind. And so in that sense, if you buy an out of the money call like Neo at $15, you are at peace up front, psychologically and mentally, departing from those $15, then having a vertical put on Tesla, which could have $100 pullback, and then there goes your mental and emotional real estate, right? And so, so with that said, based on all of those things, uh, the markets will, what you should maybe focus on if you're interested in starting the markets should be less uh, based on the hottest speaker in a specific company or tool or strategy, and more so on your psychological and emotional well-being first, your schedule second. Well, your psychological well-being first, your capital starting off second, and then your schedule, and that will determine usually without equivocation or mental reservation what asset class you may begin focusing on, and then just focus on what you need to do to acquire the success you need in that particular asset class. So I guess now I will leave it open to questions. If you guys didn't hear before, nothing I say is a buy, sell, or hold recommendation. You can lose all or more of your capital in the financial markets. This is simply for entertainment purposes only, and this is being live streamed in private or unlisted on my YouTube, on my trading YouTube channel. So if you don't want to share your name, you don't have to, but just know that. And it's not live, and I may not release it anyway, but I did want to disclose that to you guys. In addition to not selling anything, I just wanted to talk about the psychological implications of trading and investing, because I do feel they're the most consequential to all forms of financial freedom. But in the markets, you do hear market wizards, trading beyond the matrix, oracles of Omaha, master of the universe. They do tend to be somewhat more esoteric phrasing, and I do believe because it does have a lot to do with trading, with psychological components and emotional well-being, and then from there leveraging assets is not difficult, right? You can buy to open a contract quite seamlessly, but acquiring the mental and emotional fortitude of becoming a successful trader is, or lack thereof, is oftentimes what keeps us from becoming successful in the markets. So with that said, I also have a website called www.rubenonce.com, and that is a little bit more metaphysical or esoteric, and also goes over trading, which it's free. And or you can follow my YouTube, which also talks a lot about trading, and we can talk. And at this point, I'd like to leave it open to questions. Can we get a copy of the charts, Guy? What do you mean? I haven't really demonstrated any charts. You mean the slides? Yeah, I can definitely send out a copy of the slides, although they're not quite. I mean, they are finished, but it's not like a master set of slides. I just wanted to have more of a framework for this meetup on Zoom that we're having. And I don't know if you guys aren't you guys found me, or this video, what platform, because I was in a few places, but yeah, I will share this. This will also be on rubenonce.com. I will upload it. Again, it's free to register, and then also my YouTube channel. And I will leave it now open to questions. I will always do free content, open content. I've been trading for over 10 years, and I'm so in my zone that I'm not as always aware of what questions you guys might have or what you guys might want to talk about. So I'll leave it open to questions now, and feel free to unmute yourself, and we can do anything. We can open charts, look at the options chain, whatever you guys prefer. It's totally our collective group. I love you guys for taking the time to be here, and dedication to yourself, as well as trusting me with your time. So feel free to ask anything, and unmute yourself if you guys would like, and we can look at charts or what have you, if you guys would like that. Um, so I will be sharing the charts. I will also, I guess, while you guys this, if you guys want to have any ask questions, or decide if you want to, I will go to. I will share my browser if you guys want to find my YouTube channel. It's just my name, Ruben Landon Dante, and then I'll share this screen.
Hello, Ruben.
Yes. Hey, how are you? Let me go back on this. Sorry. You guys may or may not know, I've been training supply and demand for. Okay. Yes. How are you?
I'm James. Can you hear me?
Yes.
Oh, great. What are prop firms that you keep referring to in LA?
Well, prop firms are, from as I understand, they're in America, and the two that I know are Top Step Trader. So actually, let me share my browser now. So share a Top Step Trader, and I believe there's one other one that is really, or One Up Trader, I believe. So wait, what am I sharing? Am I sharing my? Okay, let's go to YouTube. So Top Step, www.topstep trader. I would always rather go with someone that is in the US, only because you never know when someone could not be a prop firm, and then and then kind of eat your money. But Top Step, this is your website. I believe I have an affiliate code, even though I don't use them a ton because I mostly trade options. But this is one, and so I would encourage you to Google U.S. based forex and futures prop firms, because we have regulations that they have to abide by, and different prop firms have different structures of risk, right? So some of them are different overnight risk. Something that I love about Top Step is that they have the ability to trade micro futures, which I always say usually a better bet to give yourself more room to be wrong than it is to leverage, right? So if you're trying to make $6,000 a month, right, you can do that with macro futures. In fact, the fact that you need so many um futures contracts to be successful, I mean, you really don't have to. So if you hold down on five micros for the Nasdaq, that's a $10 move. That's still a good amount, right? If you do $2 a point with a single micro, um, you know 100 points, which the Nasdaq easily does a day, that's $200, right? So I would rather, in my opinion, give people more room to be wrong by trading a smaller position size and doing more like a water balloon than having five contracts trading $1,000 points, and then having to restart your accounts all the time. So there is Top Step, and then there is, let me see, uh,
So, by the way, my understanding is that you, from what you just discussed, that you yourself haven't really used any of this prop firm. Am I correct with that?
I have used them. They're just not my primary tool, right? So I've talked to Top Step. I think I have an affiliate code. I have a column line accounts and all of that. I just mostly trade options.
Mm,
But I have a lot of friends that do use prop firm successfully, and they are getting paid out. I definitely have friends that use Top Step that are getting paid out at their 2080. Um, but yeah, full disclosure, I trade my own money and my own options, and haven't used or don't use other people's money to uh, trade for a living.
So what do you primarily trade, futures or equity options?
I mostly trade options. I'm mostly an options trader.
For what, equities or futures?
Yeah. Oh, no, no, equities. Mostly. So I mostly, and I was gonna go over that maybe in a different video, but I mostly trade the tech sector equity. So I never hold more than a handful of positions a quarter, and I'll day trade those positions, right? So I was holding MU. I think on MU, I'm also maybe like 1,000% ish or so return. Don't quote me, but I ended up buying the 75 strike for MU because of, and I have a video on my YouTube for why I took that trade and why it was designed that way as well as Neo. Um, and so I'll day trade a position, right? So whenever MU, I buy the 75 strike, I cashed it out, and then I supply, and then I bought in again at I believe it was the 87 strike. So I cashed that out on a portion on the impulse move up, and then I got back in towards the end of the day. So another thing that I do propose, and I'm going to go over some of your questions. Someone asked me if they can make a living trading a single stock, and I very much believe so. I know the heartbeat of what I'm trading very, very well. So Micron or MU has recently opened up high and then close lower, or close lower and then rise to the end of the day. So you begin to be if you think about the S&P 500, it's like a social memory complex of the US, right? And a Tesla trader is very specific personality, as is crude oil, as is gold. So you begin to understand the heartbeat of what you are trading, and then you can kind of master that single asset if you can make a living trading just that. Meaning that if you have enough capital to buy your own options or use your own money, you can trade the heartbeat of what you are familiar with and those moves you are again familiar with as well.
From your experience, I'm sure there's a lot of people here. I mean, I realize the group is quite very quiet. Either they're nervous or they're still asleep or whatever it is. Um, I am someone like yourself, very passionate about trading. And when I hear someone such as yourself get into the communication discussion about trading, and other people just sit quiet, either they don't understand what the industry provides, or just that's usually my thing, or they're just waiting to see what the speaker is about to offer, whether it's something new to them or whether it's not something that is new, that they're already very, very familiar with it. So in my, this is leading to my question. All these people that you have, along with myself, what would you recommend for beginner person who's getting involved in the financial market? What should be their primary thing that they should focus on? I understood what you're saying, the principle and all that. But other than that, if a person doesn't understand what the word principle mean, because the financial market has a lot of facets, but what would be the primary, from your experience, that you could say, okay, if you want to get into whether it's stocks, excuse me, whether it's trading commodities, whether it's trading future, this is what I would really suggest for you to focus on first before you even venture either doing simulation trading, whether you putting your money into it. This is what you should really understand about the market. What would be your recommendation, the very first basic thing?
The very first basic thing I would tell anyone is, what is your goal? And everyone's gonna say to make money. It's, okay, but are you trying to, like, if something what is your most immediate priority amongst many things, right? Because statistically speaking, most people win the lottery, lose it in 5 years, right? So statistically speaking, when we think about the markets, or when you're looking at the markets, like real estate, being a contractor, whatever, what's your immediate goal, right? Is it, I want to provide for my family? Okay, well, what is that? 5,000 a month, 4,000, 6,000, 8,000. Based on that, if it seems more like income, the next question would be, well, how much do I have, right? If you have, I would say if you have at least 10,000 ish dollars, primarily focus on options because of the various tools, right? But I would say below that, I would focus then thereafter on if you have an iPhone, you have the stock. If you swipe left, you see like the stocks, right? Is there a specific stock you've been looking at? Is it Apple? Is it Google? Whatever it is, right? If it is, for me, that's how I knew I was drawn to the Nasdaq before I knew much about the Nasdaq futures itself. Right? I always intuitively follow the pattern in which Apple was moving, not paying a lot of attention to it, but I would look at it. Right? If that's the case, is there something that draws you? And if it is, for example, Apple, Google, or any of the tech stocks.
Okay, Ruben,
Mhm.
I must interrupt you for, I think, let me rephrase it, make it a little simpler. What would you recommend the basic tools for a person, a beginner, to get themselves acquainted with, to be able to really fully understand before they get involved in the market? One specific tool that you could say, hey, use this, try to understand how this worked before you even think about, trading or investing or whatever the case may be.
Um, I would say what makes options different from forex different from futures, and then figure out what resonates the most. Like some people like, for example, forex because they do have a lot of leverage, and because they're naturally just attracted to forex for whatever reason, right? If that's the case, then great. Then focus on USD pairs, I would say, because they're most consistent. Um, and then and if it's futures, focus on what you already know. For most people, they do know the Nasdaq or the S&P.
All right, great. Thank you. Appreciate
Yeah,
it.
of course. I hope that was helpful. Um, yeah, because once you kind of understand the Nasdaq or the S&P, if you're drawn to futures or forex, the non-exotic pairs, so the classic pairs, you can focus on if you want to do a micro contract or a standard contract, and then focus on how to do it. So I see someone raising their hand. So if you want to unmute Susan, feel free to do so, and yeah, ask away.
Hi, thank you so much. I came in a little bit late, so apologies.
No
I'm
worries.
piggybacking off the last question. So let's suppose a brand new, complete novice. I have $1,000 that if I lost it, it wouldn't be the end of the world. What would I do with that $1,000 today to get started?
You said if you had $1,000, which would be the end of the world if you did lose it, but you want to trade specifically options. Is that your question? Correct?
Yes.
Yes. Okay. So if I had, without making any buy sell recommendations, if I had $1,000, which I could not lose, and I really wanted to focus them specifically on forex, I would
Oh,
specifically
I'm sorry. I could
options. Excuse me.
lose. I wouldn't miss it.
I'm sorry. Oh, you said you wouldn't miss it.
I would not miss it.
Okay. If I was going to do $1,000 on options that I would not miss, I think it would be the same. I think I would focus on at the money or slightly out of the money calls on higher time frame pullback. So what I mean by that is, let's see. So um, what has pulled back quite a bit? So there's a few things to consider, right? The tech sector has been outperforming the general market for obvious reasons, right? So the tech sector can sometimes be a little bit more profitable in terms of turnaround. Well, yeah, in terms of time and profit, it can be a little bit better because it does move a little bit more. So I would consider options on maybe someone like an AMD, right? If you are bullish AMD, we can see a correlation here. So let me see. So let's look at your weekly, right? So we can see how AMD moves, right? So the reason I say AMD is because a lot of people love NVIDIA, right? And so if you look at NVIDIA, so let me go to, let me move this really quickly somehow, if I can figure out how to,
Ruben,
yes.
yeah, may I just throw interject on Susan's question right now? As an individual such as I am, Susan, a beginner trader, what I would do is take that 1,000, invest it in a company. That means buy stocks. Either I can buy 5 shares to 6 shares of Apple, which is running around $100, and just wait and see what would happen, because As long as Apple is in business, I know I will get a return on the cash that I put in. Or I just take one and buy, or just go after Tesla, buy one share of Tesla and hold on to that. As you notice, I mean, you may not, as a beginner trader, got cut off.
Wait, no, no, we can hear you.
Okay,
I can hear you.
okay. Anyway, a few weeks ago, or let's just say several weeks ago, Tesla did a 1-to-5 stock split. So if you had one share, you would have gotten 5. And now Tesla's running around 800 and something dollars. So just imagine that. It's a time frame situation. So if you had $1,000 and you're not really in a cash crunch and you're willing to wait, that's what I would suggest, something of that nature. There are other companies, like AT&T, which are cheap, which is cheaper, $45 or so, where you could invest your $1,000. Buy a few shares. You don't have to buy 100 shares, but take that and buy and hold.
Well,
That's it.
yeah. To piggyback off of what he said, the tech sector is great, like you said, Tesla and a lot of those. So if you're buying, if you have $1,000, right? A lot of people love, like he said, Nvidias and Teslas. The thing about Nvidia is, if you see here, which is it's popular, it's pretty popular. You can see it's uptrend, right? But you can see that Nvidia, you can see the correlation. These two charts are almost pretty much identical. You guys can see my charts, right?
Yes.
Yeah. However, Nvidia is trading at $534, while AMD is trading at 90, right? So, but the correlations are the same. Now, all things being equal, right? If we're going to just buy a stock, you can essentially buy about 5 units of AMD, which would be equivalent to one share of Tesla. And if they both move 10%, you're pretty much be making apples to apples. But because you did say options specifically, options tend to be less inflated when the price of a stock is cheaper. So you may be able to essentially maybe consider, if you're comfortable, buying an AMD at the money or out of the money call that would have a very similar move to an Nvidia, but it might be cheaper to buy, meaning that instead of committing, maybe let's look at the options chain. Actually, let's just do that.
Well, Ruben, may I interject for a
Yeah.
minute based on that, because in all fairness, if she mentioned that she has $1,000 to spend, again, my situation would be to avoid option, reason the risk. Option tends to have a tendency to decay, as you have already stated. So if you put that $1,000 can be wiped out the next day, depending on the circumstances, whether you buy a
which is
put or a call.
right, which is why I said specifically buying out of the money calls, right? Because
It doesn't really matter whether you buy out of the money. It degrades. If you really trade option, you want to understand that it doesn't even matter if you buy a leap year option, because again, everything is dependent on the share, the stock
but,
price.
well, she also
So
specifically said she was looking to, right, Susan? Am I correct? I believe you said specifically options.
I think it was just using the term generally. So I'm not sure of the difference between options and anything else, but I'm open. I just wanted to know what would be option.
Oh, I see. I see. Right. Open-ended question. I see. Okay. Well, I want to clarify on something that James said, which is, yes, your money or the option can expire worthless. So the second thing that I was going to say is I've never bought options that expire within less than the next 3 months, right? Is one. Two, I would never, the reason I say at the money or out of the money is because it tends to be a lot cheaper. So you're risking a lot less money, meaning that if you buy the stock outright, if you buy Nvidia or AMD or Tesla, if you buy Tesla outright and tomorrow it gaps down $300, then you're down $300. In contrast, if you buy a Tesla call that is, or an AMD call in this example, right, that is near the money, right, or at the money, let's say $100 in this, it might be 6 cents, for a weekly. But if it goes to zero, the most you lost is those 6 cents. You wouldn't lose the stock itself going to zero, which is why I specifically said depending on your particular concerns, options could make the most sense. Because if you're buying, the point with buying out of the money or at the money was not to say that they don't lose money. It was to say that your controlled risk is upfront versus buying the stock outright. A Tesla could pull back $400 and then you're out $400. A Tesla at the money could maybe be now here there's leverage and stuff, but to rewind, basically kind of going back where I had left off, when I said AMD versus Nvidia was because of the way they move, right? They move similarly, and so you can capture a similar up move. And so then I said that the call specifically would be cheaper. Now, going to clarify what he was saying is that if you buy a stock, theoretically, yeah, the option expires, but the stock could also go to zero, right? The stock could also have a 25% pullback. So if you were to, for example, the reason I keep saying buying a call is because that is the most you're going to lose. Meaning that if a $10 call is too expensive, then don't buy the $10 call. Then don't even look at that stock, right? Well, a $10 call would be a thousand-ish dollar because it's 100 shares. And so does that make sense? So theoretically speaking, yes, options do time decay, right? But in the same respect, if you're comparing apples to apples of buying the stock or buying the at the money call, the at the money call is only going to lose how much you bought it for. So in this case, if AMD is $90, right, and the at the money call or out of the money or at the money is 145, if it goes to 80 by the end of the day, you only lost 145. But if you had the stock, you lost those $10. Does that make sense? So the most you'll ever lose when you buy an option is how much you paid for it. In this case, if you bought it for $145 because it's 100 shares, you multiply it times 100. By the end of the day, let's say that it goes to 80, the most you lost is 145. If you bought 100 shares, you would have lost $1,000. Does that make sense? So when you buy an option, your control is up front, right? Inversely, if AMD goes to 110, that $90 strike call, you're buying a coupon, right? So you're buying a coupon with an expiration date. So if an AMD goes to, let's say, $100, then this coupon you have for 90 that you paid $1.49 for is now worth $1,000, right? So your upside can be apples to apples if it's about to expire, but your downside, the most it is how much you paid for the option. Does that make sense?
Okay.
I'm not
It
making any buy,
does.
sell, or hold recommendations. I'm simply saying I would consider the tech sector, and I would
Right.
consider those stocks that are maybe like $75 to $150, and consider if you buy the stock too. The difference here is also leverage, because if you bought one share of AMD, you're spending only 100, or you're spending $90, right? You're buying one share for $190. If it goes to 100, you made $10. However, in the call here, the at the money call, that's a strike at $1.45. It's 100 shares, right? So if it goes to zero, or if it goes to 80, you lost $145. But if it also goes to 100, now you made that times 100 shares. So you made it would be worth $1,000, but you paid 150 for it, so you would have made $850. So in buying one stock share for $90, if it moves to 100, you made $10. If you take $150 and it moves $10, the same $10 for that extra a 50-cent risk, you made $800. Does that make sense? So the benefit of a call when it's at the money or out of the money is that if you only have $100 to invest, or let's say in this case 1,000, which I would never put all 1,000 in one position, I would play with different stocks, right? So I would maybe consider buying, honestly, I maybe would consider buying different options, maybe that expire no less than, I would say, at least a month, and maybe not using more than $300 and just observing how different ones move, if that makes sense.
Okay.
I, I feel that it probably doesn't, because that was a lot of random information. So feel free to ask me to clarify anything, or James.
Well, it sounds like there are two options. One where you simply buy it straight out and it's going to have less movement than buying the second. And I don't know the two different names of what you were describing, but the
Yes.
second seems the coupon, where you're sort of gambling on what you think the stock is going to do and having a bigger payout.
Correct. So I would say with price action education, it would be less gambling, right? Because, for example, if it has supply at 120, right, and I will link a video. I will link my MU video, because I explained that quite a bit on my YouTube channel. But basically, um, let's say Apple. Let's say Apple is $100, and let's say that over the last 3 months, it has moved $20, right? Well, if if it moved up $20 over the last 3 months, right? And then it went up to 120, but then it pulled up to 100. Well, historically speaking, if Apple tends to move $20 in the course of 3 months, you could maybe consider buying a $115 call that's maybe $1 to potentially ride it to 120, which is what it has historically theoretically done, and maybe have a reward of 500 for that 100 you risked, right? So that's a lot more advanced, and I wouldn't expect anyone to necessarily understand that as I'm talking about applying options per se. But what I am saying is, you can methodically, looking at a range of any stock, right? So if you're seeing, going back to the Apple example, you're seeing Apple move $20 per 3 months and it's $100. You can buy one share for $100, and you bought one share. So if it moves to 120, you made $20. And or you can buy an option that expires 3 months from now for 105 for that same $100. And if it does move 20% again, or $20, you potentially made 1,500 over that $100 risk, right? So then it's just kind of looking at the way the coupons and the mechanics work in context to what you're looking at, if that makes sense.
It actually does. It does.
I'm glad, because I know sometimes I can go very fast and from 0 to 60, but yeah, and I plan on doing these meetup groups if you guys are interested, like once a week or twice a week, and just kind of talk about trading and market perspective, and kind of see how you guys feel and where you guys are at. But yeah, on rubenons.com, which again, it's free, or on my YouTube channel, I go over this, and I also have a video called first principle. No, it's called like robust lateral data, and it kind of goes over all those different mechanics. But again, I plan on having this at least once a week if you guys are interested in that in any way. Hey guys, so let me see. So let me share this screen. Share. So this one, I go over the basic framework of my supply and demand thinking. And then in the videos, there's a few stocks that have made me like well over 20 times return. You can follow every step of why I did it, right? So there's NEO and there's MU. So NEO, the first video is like 6 months old, but you can follow all the NEO trades on my YouTube channel, and you can see how they were making money, why they were making money, why I took the option instead of the stock. And really, explains not only the mechanics of options, but the evolution of how it was moving in context to the stock, right? So if I had taken, I put $300 of options in Neo with an out of the money, quote unquote, gambling kind of an option call, which was very methodical in this case because of the way the money was rotating from Tesla to a Nikola to Neo. But those $300 turned into, I cashed a lot of it out, but it turned, I bought 15 units at $15 each, and each one of those $15 turned into roughly 5,000, right? So if I had taken $300, if I had taken those same $300 of Neo and just bought the Neo stock, that would have been maybe 100, it would have been maybe 100 shares at the time because they were like $2, right? Not even, yeah, but let's say 100 shares for easy numbers. Well, 100 shares times 50 would have been roughly $5,000, would ended up being more like 30 or 40 grand. And I still haven't cashed out some of those positions. But the benefits of the options when you buy them, as I said before, is that the most you'll ever lose is how much you paid for them. So yes, how much you paid for them can go to zero. And in the AMD example I just showed you, you could lose all $150 for the potential upside of maybe a hundred, a few thousand. And or though you can buy 100 shares, which then would be your all pretty much all your money would be $900, and that can pull back. If that were to pull back, if you bought uh those 10 shares and they pulled back $10, then all your money would be gone, versus with the call you're controlling 100 shares for only $1.50 that expires. Yes, it does expire, but we can talk about those risk reward benefits more comprehensively, because like or how do you feel about kind of the two different outlooks when it comes to equity outright buying a stock and the option in this example? um Please, oh, thank you. Okay, so let me read your comments. Oh yeah, yes, Lisa, I believe that is cleared. um Buying buy and hold investor, what can I learn from applying options like you just mentioned? Well, something that you can learn as a buy and hold investor in options, right? Because actually that's a really good question that I applied only last week, I believe, ahead of inauguration. So what I ended up doing is I had about 200 shares of Neo, and those 200 shares were roughly $60. And so what I ended up doing is, if there was a 20% pullback, right, if something crazy happened, well, those, that money, that 10,000 or so dollars would pull back to lose like 4 grand, right? If theoretically, which was unlikely, going to be a 20% pullback, right? So what I ended up doing is I ended up cashing out my stock position and buying the calls at current price, right? So I ended up cashing out 200 shares, which ended up paying me, I believe, like 10 grand. And now those $10,000 were liquid. And what I did was buy the Neo option at the same strike, which was, I think it was $1,000. And if it had a 20% pullback, let's say, I would only lose that $1,000. But if it moved in my favor, I would keep capitalizing at the same rate I was just holding the stock. So to answer your question is, in high risk positions or high risk market conditions, you can swap out the profits you've taken from a stock, theoretically speaking, without making any seller or buy recommendations. And you can buy the strike at the same uh, current value, but now you're only risking how much you paid for that strike versus the entire principal value of those stocks. And or if it ends up, and or you can price in the break even better, right? So um, let's say that in this example, um, let me close the strikes for January, and let's go with the weekly. Let's go with the weeklies here. So let's say that let's say that we have $9,000 of AMD stock right now, right? And let's say that we're nervous about the upcoming week. Something that we can consider doing is cashing out that $9,000 of that Neo stock, which would be, 1,000 shares. And we can consider then buying the weekly call, which is equivalent to our share position size, which would be 10 of them. Um, and if we did it at $90 exactly, we would pay $3,000 for that, right? So at which point it would be here, the price move, right? So right here now, AMD is now $1. It's $91.12. So then we're intrinsically paying $2. And I say intrinsically because this is $90 strike, right? But AMD is $91.13. So one of those dollars is already in our pocket, right? So we're paying $2. So then if we swap them out in a high risk environment, we cash out our $9,000 and essentially now pay $2,000 to hold through this risky time, right? To hold through this week. And in doing so, if AMD were to have a 10% pullback, rather than losing, or like, and you have to price it out too, right? Maybe that won't make sense so much for 10 cents, but like, let's say if you had a $20 pullback, which is unlikely, right? But you have to analyze the risk reward. If that were to happen, you would lose roughly $2,000. So in this case, swapping them out may not make sense, right? Because um, you're paying $2 of extrinsic value. You're paying $2 for the insurance, right? Because that's the extrinsic value. And what is the likelihood of for you to lose those $2,000? You would have to pull back um, $20, right? So that's unlikely. So maybe in this case, swapping them out didn't make sense. For me, swapping them out for Neo did make sense. And or what you consider is buying the put again. And so oftentimes, whenever you see the price, whenever you see it not make sense on both sides, it's likely that it could that risk is somewhat artificial, can revert back to a higher price depending on market conditions. But oftentimes, if neither side makes sense, then you can often consider yourself somewhat safe in this regard, um, if that makes sense. So something that's important, and that's why I always go by break even prices over the Greeks, because if you just go by by pure break even, if you buy the call that expires, does this expire in a week, right? Yeah, it just may not make sense. But then we can try different expirations, right? So um, here, if you were to do six, so then you guys might ask, well, then why would someone want to buy a $6 call uh, for a $90 strike when they can just buy the stock for $90? Well, because the difference is that for those six, this would cost you $9,000 to get 100 shares. 10 shares would be 900, 1,000 would be 9,000. Excuse me, 100 would be 9,000. And here you're effectively controlling $9,000 worth of money. And you're effectively paying, $5.60 for it. So if it moves in your favor, to $100, these $6 then turn into, a $400 upside. Versus here you would need 9,000 to see that same $400 upside. So that's why that can happen that way. And sometimes using options does not make sense. Sometimes, depending on your position size or a specific stock, may not make sense. At which point, that happens a lot to me, where I'll be like, oh, actually, options on Neo doesn't make a lot of sense. And if I cannot use the leverage for options as they're intended to, then I'd rather just trade something else, right? Trade a different stock. And so but in some market conditions, it could make sense. Like for Neo, for me, ahead of inauguration, I was happy to pay, I believe the extrinsic value was like $200, but I also have the valuation increasing of a 2-month upside versus the risk of a pullback during that week. So it just depends. And the purpose of first principles thinking, in my opinion, or in this video rather, is so that you can have the mental framework to discern for yourself what does and doesn't make sense without having to memorize a strategy. You can look at the mechanics of options and then ask yourself, I'm holding $9,000 in the market with 100 shares of AMD. Do I want to hold them through inauguration week? If so, what's the worst case scenario, right? How much did it fall during COVID? I might use that as a benchmark. And if the worst case scenario is a 20% pullback and it's $2,000, and then swapping the stocks of $9,000 for the option, paying $2 of intrinsic or extrinsic cost, meaning $2 for the insurance, well, then maybe it doesn't make sense to swap them out because you're paying those $2,000 of risk, you're paying them in insurance cost. So for some stocks, it might make sense, or it might make sense at sometimes during the day, but not others. So that's how I would apply those accordingly to see when they may or may not benefit. If that answers your question or if that helps. So I don't know if anybody else has any questions about that, because I think maybe this one is a little bit of a doozy. We went over a lot in an hour and a half. I think maybe more than you probably would go over in a classic sit in person workshop. But feel free to ask me anything, and if not, then maybe we can set the same meeting. We can set the same meeting maybe next Friday or Sunday, and then I'll do a repeat of the whole presentation on Saturday again, next Saturday. And of course, you can always go to www.rubenonso.com and rewatch this, and then also have a lot of the videos there. And you can, what is my NEO price prediction to the end of 2021? I'm usually really pretty accurate with those predictions. Right now, I feel like the market's gonna mostly yo-yo to good buying opportunities and good selling opportunities, and I feel like some sectors of the year will likely come out flat. I feel a NEO. I feel like NEO could end around current price, and have wild moves, or maybe around. I'd be happy if NEO goes to 600 as well. Yeah, and then we can actually look at a lot of this during the market open. Like I said, if you guys are in my channel at all, I do a lot of live market trading. And I also go over a lot of like my train of thought and mechanics on, like I said, on rubendante.com, which is pretty much free to sign up. You just put your email address and password. And I do have a lot of other educational content in terms of trading, but you can find it all mostly on my YouTube as well. And it's laid out mostly from beginner. So it goes from like starting your trading plan to setting up your platform with interactive brokers to price action to watch lists and scanners. So this can kind of take you in a congruent upstream of information if you are just starting out. But yeah, I do plan on doing more of these. So yeah, feel free to ask me anything, guys. And I guess we'll be here till 1 if you guys have any questions, or another 24 minutes. And or we can kind of sleep on all this information and then go over it again. In the meetup group, also feel free to post questions, and then I'll hold these more often as you guys might be interested, if you guys would like. Having trouble with the microphone, been doubling options. Would like to know if you can share some of what your strategy is for trading. I understand the mechanics, but not so much finding of buy and sell. The statistics only based on normal distribution. Okay. Yeah. So yes. So, the way I find my next trade is breaking on a few things. I do look, I do have my watch list to which I create my buy and sell zone alerts in different stocks, right? And I make the alerts or the alarms based on like if an apocalypse was coming, I would want to buy it at this price no matter what happened. For me, Neo is $18, right? Which is way lower than it is right now. That's where I would put the alarm. Not saying that I wouldn't buy it at anything above that or get back in it. I'm simply saying that's the price where I would put that alarm, that I would get into it. And that alarm for me means that I'm going to get into this no matter what's going on, whether it's one share or 100. It's upon discernment at that point. Um, but with that, I that's usually how I start off. And then once that happens, um, so Micron, the way that happened with Micron is that it pulled back during earnings, which I thought was very predictable because of the way earnings tend to mirror the reverse of the previous cycle or year. Um, and so for me, I was looking at Micron and I was um, comparing it to the market cap of Nvidia and AMD, which are other two micro semiconductors. And because those market caps were so much bigger and MU had just pulled out or had just pulled back, based on the movement of the sector, I bought out of the money calls with that predictive movement. So let me show you guys. Oh, wait. Oh, yeah. Let me show you guys. No, MU. Which is actually, it is almost exactly what happened. So I got into MU a few months ago with an out of the money call. And what ended up happening was I was comparing it to the other semiconductors because there seemed to be a sector rotation. Not a sector rotation. Sector rotation seemed to become a lot of stock rotation within a sector. And so I was comparing it to the moves that NVIDIA was making during that time, which was, so is this a weekly? So if you see here, on the inception of 19, it was at 122. It went to 190 within 4 months, right? So that's almost a 100% move there. Let me make sure that's right. Yeah, October 19 here, and there's a good example. It went from 121 to 190, right? So that's, I mean, it's not 100%, but it's a good like 60-70%. So saw Nvidia doing that, which is also in the same general sector, and then seeing AMD do the same or similar. I said, well, MU, another micro semiconductor, had not had that same opportunity or that same kind of up move, and in the same respect, it was I had a market cap valuation that was much lower. So going to here, we're going to go to the MU market cap. So the MU has a market cap of 92 billion now, but I got in when it was like 60, so about 20% less. So it was like 70 billion, I believe, at the time. NVIDIA has a market cap of for $339 billion, and then AMD has a market cap of 111. So and especially comparing AMD to MU, it had a long way to go, and it never quite had that upswing that the other two semiconductors had within oh, sorry, let me share my chart again. Excuse me, guys. So back to my chart. You can see, excuse me, that so let's go back and show you guys again what happened. You can see NVIDIA here. I believe it was here 19. You can see here, December kind of getting started at 123. And then you see here the peak of 190 in April. So roughly 4 months. So that's a 67% move. MU or Micron never quite experienced something like that per se during that time in those particular market conditions, right? You see 27 here, then you see kind of like 45, but never quite. And then you retested that. So to me, because of the market cap and because of the way the sector tends to move out of in Nvidia and in and other two semiconductors, that's why I ended up with that trade, right? Same with Neo. With Neo, I saw so I got into Neo at the very bottom, like around $2, but I ended up buying the calls, the strikes. So going back to before any of that had happened, you can see that Neo, in contrast to Tesla during that time. So if we go back to, what is this, February, March. So let's go back to, you can see that, oh, we are way back in time. November, October, August, June, April. You can see that Tesla was doing somewhat of the reverse. So basically, what I was able to find was there was a rotation within Tesla to Nikola, and then I felt Neo was next, and all the other things line up: supply, demand, the pullback. So that's why I was able to, and the reason I chose a $6 strike is because that was the breakout. That's where supply would have become demand to take off, which is exactly what happened. So that's kind of how I go by the biggest supplier demand in a specific context. So the longer the better, right? If it's the best price it's been in the last 5 years, I'll take that versus the best price it's been over a week if I'm looking at a watch list. And then I will look at correlated markets, the sector, and then so what I'm doing is very, I mean, it's pretty advanced, right? I would say it's very much, even for a hedge fund, right? I structured a position for a $24 million account. So there's a lot of mental components that go into my trading style. The purpose of this meetup is to begin to swim in like the 3-foot pool, and then kind of begin to build on that as the team and the group develops. And of course, you can see a lot of this stuff on my personal website and what have you as well. So I don't know if that helps, guys. And what are you guys looking at now? Let me share screen. Maybe go back to this. So yeah, I hope that was helpful. And again, feel free to ask me any questions. Otherwise, I'm probably gonna close out here soon. If no one has any other questions. Thanks, Jose, for letting me know. I think there was another question I wanted to answer from you. So in terms of what could happen, that is where I use not so much the average. I really don't use indicators, but that's where I do use sector, historical moves, and then individual historical moves, if that helps. And then oh, I'm sorry, Lisa, about Neo. Yeah, it's a weird one. It's been a weird one. Some of your strategy for training is just the mechanics, not so much finding and stuff. Okay, so yeah, guys, I think if you guys feel free to ask anything. Thank you, Susan, so much for being here. Yeah, and thank you so much for joining our various groups, and I'll be scaling this more and more and more, and I'll be doing them maybe more often. So again, feel free to sign up to rubinauts.com. It's free, and there's a lot of training information on there, and or my YouTube channel. And feel free to also shoot me an email at rldprivateclients@gmail.com, or you can, there's a community page on my rubinauts.com, and you can always post questions there too. And yeah, I hope this was helpful. and yeah, it's a lot of information. I was like, maybe, no, sleep on it. Don't be overwhelmed. No, it took me 10 years to master this. Don't don't be discouraged if you don't quite understand it. And yeah, just register to rubenouts.com. It's free. Email me and register to our groups where you guys, the various new media channels you guys found this. And yeah, and then we'll do more of this. And I hope this was helpful. And I think I will be getting more into education. So I love you guys. Thank you for being here, and I will see you guys next time. Bye.
Bye. Thanks again, Ruben.
Bye. Thank you so much, Susan. Thank you so much for being here, guys.